Today we are looking at Nvidia. This is one of the clearest winners from the AI boom. And the numbers are not imaginary. Nvidia is generating massive revenue, profit and free cash flow. But the stock question is different. Is the AI leader still attractive at this price, or is the market already paying far too much for perfection? The simple thesis is this: AI leader, premium price. By the end, you'll know my fair value range, the buy zone where the risk reward gets more interesting, and the three numbers that decide this thesis. $215 billion of revenue, about $102 billion of estimated free cash flow, and $120 billion of net income. This is not financial advice. I'm using the numbers for education and research. If you enjoy plain English stock analysis that separates real opportunities from overpriced stories, subscribe to FinanceToGo and let me know which ticker I should cover next. Nvidia is not just selling chips into a hot market. It has become a platform for accelerated computing. The GPUs matter, but so do networking, CUDA systems, software, and the developer ecosystems around the hardware. That is why investors give Nvidia a premium. It's not just a cyclical chip company when demand is strong. It is closer to the default infrastructure layer for a lot of AI spending. That sounds great, but here's the catch. When everyone already agrees the business is elite, the stock has to keep proving it. The latest annual filing shows the scale of the business. Revenue was $250 billion, net income was $120 billion, estimated free cash flow was about $102 billion. That is the difference between Nvidia and a lot of AI hype names. The story is already showing up in cash. What improved is obvious. AI data center demand is huge. Free cash flow is massive, and Nvidia has a balance sheet that gives it flexibility. What got worse is more about expectations than business quality. At this price, good numbers may not be enough. The market wants continued dominance, continued margin strength, and continued AI spending. So the latest numbers support the bull case, but they also raise the bar for the next section, the FinanceToGo scorecard. My FinanceToGo score is 8.4 out of 10. Profitability, cash flow, and momentum score extremely well. Nvidia is doing what investors want a top-tier compounder to do: grow fast, earn high margins, and convert the story into real cash. The lower scores are valuation and risk. Not because Nvidia is low quality, but because a premium stock can become fragile if expectations move down. For me, Nvidia is not a proof problem, it is a price problem. The price chart tells a simple story. The market already knows Nvidia is elite. This is not an undiscovered stock. It is one of the most watched companies in the world. That does not mean the stock has to be avoided. It means I want to separate business quality from entry price. The better the business, the easier it is to justify a premium, but the harder it is to find a true bargain. My fair value range is roughly $800 to $230. The buy zone is lower, around $170 to $180, because I want some margin of safety for AI capex risk, customer concentration, export controls, and the possibility that growth eventually normalizes. I'm not trying to get the exact number down to the penny. I'm trying to see whether the current price gives enough margin of safety for the risks. In the bear case, multiple compression or an AI spending pause could pull the value towards $130 to $170. In the base case, Nvidia remains a premium leader around $180 to $230. In the bull case, AI demand and free cash flow stay exceptional, and the value can move above $250. The bull case is powerful. Nvidia remains the default platform for AI accelerators. CUDA Networking and systems make the moat deeper than just one chip generation. And the free cash flow means this is a real quality compounder, not only a future promise. What bears may be missing is that Nvidia can look expensive and still keep compounding if AI spending stays strong. A premium multiple is not automatically wrong when the business keeps producing premium results. The bear case is not that Nvidia is a bad company. The bear case is that the stock already expects too much. Hyperscalers could optimize spending, use more custom silicon, or slow the pace of AI capex. Export controls can limit demand. Competition from AMD, Broadcom, custom ASICs, and other architectures can pressure future growth. What bulls may be underestimating is multiple compression. If the next guide is merely good instead of exceptional, the stock can fall even while the business remains strong. The main thesis breaker for me would be data center growth slowing sharply for more than 1 quarter, or free cash flow weakening without a clear temporary reason. My FinanceToGo verdict is buy, but not cheap. Nvidia is high enough quality to keep a positive rating, and the AI infrastructure thesis is still backed by real numbers. But I would not call it a strong buy at this valuation, because the margin of safety is not wide enough. The thesis improves if data center growth stays strong, gross margin remains elite, Blackwell demand holds, and free cash flow keeps compounding. The thesis weakens if guidance rolls over, custom silicon takes more share, or the market starts questioning AI capex returns. The reusable investing lesson is simple. A huge growth story can be real and still require price discipline. Great business and great entry point are not the same thing. If you want more stock breakdowns like this, subscribe to FinanceToGo and comment below. Is Nvidia still worth paying a premium for, or would you wait for the 170 to 180 buy zone? Again, this is not financial advice, it is educational content only.